You are in the middle of a loan process or thinking about getting a loan to buy a house, you will soon understand that there are a lot of acronyms and terms in this business. We're here to debunk and demystify and provide a decoder ring for those acronyms. I'm with Willis Richardson, and we're going to get started right now. How you doing, Willis?
I'm doing great. How are you doing?
I'm good. I'm good. We are going to talk mortgage terms and acronyms. I was, before joining Pure Funding, I was at a startup in the healthcare space, small business health insurance, and we had a one of our culture company values was no acronyms. Couldn't use acronyms in email. Couldn't use acronyms in the office. It's like, if we're going to start sending those things around, and we're expecting customers to understand, so it is something that happens in a lot of industries, and people are left wondering, what do these mean? So
I try to make sure all of our emails go out without acronyms, because nothing makes you feel crazier than seeing an acronym.
Yeah, you don't want to ask. You don't want to be like, hey, I have no idea what that means. But,
exactly.
You're leaving the customer to go out and find their own answer. So, hopefully we'll clear up some of that. And if there are others that you're running into, and even if you know what the meaning is and would like a deeper understanding, just leave us a comment. We'll do a follow-up video. So let's roll into kind of the most popular ones, the most common ones we run into through a transaction. The first one is DTI. What is DTI, Willis?
So DTI is probably the most important acronym when you're getting qualified for a loan. It stands for debt to income ratio. And each different kind of loan has a different debt to income ratio that we have to verify for approval. So when it comes to approving your loan, a lot rests on your debt to income ratio, or what we call DTI. So it's a big one.
Got it. And so what that's looking at is all your outstanding liabilities that you have prior to buying the house, and the proposed monthly payment of the house.
The new house. Yep.
And held against your income, right? And what that percentage is, and it's what lenders really use to determine, is there an ability to repay this loan based on the income that this individual or couple or whoever's buying the house has. So that's DTI.
Exactly.
Next one, LTV.
So LTV stands for loan to value, meaning how much of a loan are you going to have compared to the appraised value or purchase price, whichever's lower on a purchase. And then if you're doing a refinance, then just compared to the appraised value. So sometimes on those kind of loans, especially if somebody's putting down more than 10%, or they're refinancing and they have more than 10% equity in the house, there's potential that we might not even have to do an appraisal. But outside of that, we have to get an appraisal done, and then it's the amount of the loan compared to the appraised value or what the home is worth. So great.
Got it. Next up, CTC.
So CTC is the favorite acronym of every single realtor, transaction coordinator, everyone in the deal. It should be what you're looking for when you do a loan, because that means you're cleared to close. Nothing else can come up. Everything has been cleared with title. Everything's been cleared with the lender. Now, sometimes title and lender have different CTCs, so you might be CTC'd with the lender, but not with title, or vice versa. So there are both, but once both of those are CTC'd, nothing else can come up, and you're just waiting to close. So that's the exciting acronym, CTC.
Yeah, and in our world as loan officers, we work in good faith with customers, so we don't make a cent until unless the loan closes. So that acronym is very important to us. We want to ensure that our customers achieve CTC, clear to close, as fast as possible, so that we do not disrupt the deal. Next one, PMI.
So it deals with personal mortgage insurance, and so or mortgage insurance, MI, depending on what kind of loan you're having, and that's what you have to pay to the lender if you don't put more than 20% down. Now, PMI is used on FHA loans, and you're going to have PMI regardless of whether you put 20% down or not. That's the nature of an FHA loan. But if you're doing a conventional loan, it's called mortgage insurance or MI. And but both of them mean that there's an insurance that you're paying on the off chance that you do not pay and the loan goes into default, because that will make the lender whole. That insurance will make the lender whole if you were to default on your loan.
Got it. So north of 20% down payment outside of outside of even on FHA?
Yeah, even on an FHA, you still have mortgage insurance.
Yeah, north of 20%, you're not paying mortgage insurance. And, on a sizable loan, it can be a pretty decent chunk of money that you're paying on a monthly basis.
Oh,
so
yeah, definitely.
That's what we always say. If you can get the 20%, get it. It's going to save you money in the long haul. The next one we have is PITI, PITI.
PITI. So PITI stands for principal, interest, taxes, and insurance. So now you can also have PITI HOA. That's a fun one, just to say PITI HOA.
Wow. PITI HOA.
Yeah. Principal, interest, taxes, homeowners insurance, and HOA. So that would be kind of a total payment. No one really escrows HOA fees, but if you're looking at your debt to income ratio, or the DTI that we talked about earlier, that's a big number that goes into what you can actually afford. But it's all the aspects of your monthly payment.
Got it. So it is part of DTI, the interest, the principal and interest, obviously, but the taxes, insurance, and in some cases the HOA, and the
mortgage insurance, which is funny that it doesn't.
And the mortgage insurance.
The mortgage insurance is on there too, but it's not in the acronym.
It doesn't get a part of the acronym.
It doesn't.
Poor PMI. Poor PMI has been left out.
Always left out.
We have to see about that. How do we give mortgage insurance its due?
Yeah.
Last one I had here is APR. So when customers receive, hey, what's the interest rate? There's one number and then there's APR. Can you explain APR in a clean way?
No. So APR is annual percentage rate. So what it is it is a combination of the rate you've been quoted along with the fees to get that rate expressed as a percentage, so that you can compare two different people's 6.5 interest rate. Yeah, they're real offers. So two different lenders might give you 6.5 for the interest rate, and that is what your monthly payment's based off of. But if one person has a 6.6 APR and one person has a 7.2 APR, then the 6.6 is a cheaper way to get to 6.5. But it's a government number. APR, annual percentage rate, and that's calculating it. Don't ask me how to do that, but what it is your rate plus the cost to get the rate, and whichever has the lower APR is going to be the better option for you.
Yeah, we should do a subsequent video on points and understanding when it makes sense to buy down the rate and what have you. Sure. A clean description of that would be great. So those are the most common that we run into on a daily basis. If there's others that you guys are out there that maybe you understand the words, would like a deeper description or how it factors into your ability to get the loan, leave a comment. We're happy to do a follow-up video on some of these. We'll probably delve a little deeper in some of the other common terms and some of the documentation that's shipped out to just explain what you're actually reviewing, what you're signing, and what it means. So if you haven't already, give us a subscribe, give us a like. It really helps our channel. We really appreciate it. And Willis, thanks as always for lending your knowledge and demystifying the acronyms of the lending world.
Trying to. One acronym at a time.
One acronym at a time. Awesome. Have a great day, everybody. I hope you enjoyed the video. We will be back soon. See you later.
Bye.